Have you ever wondered where to put your money? I've got the answer for you. We're going to compare real estate versus stocks versus gold and silver. Have I got the answers for you right here on Moveonomics? Hello and welcome to Moveonomics. I'm Peter Fife with Coldwell Banker Northland in beautiful Prescott, Arizona, where Prescott is everybody's hometown. We'd love to make it your hometown too, but today we're going to do some education. Let's talk about real estate investing and where's the best place to put your money. Did you know that if you had $250,000 in your bank in 2011, right now, because of what's going on in the economy and how inflation's happened, you would need to have at least $349,000 in the bank to have the exact same buying power as 2011. This is from the federal government site that tracks this stuff. This is where I got this information. Now, people ask me, where's the best place to put my money? And that's always a good question. And so I put pencil to paper and figured this out. For example, if you were to put your money, $250,000 that you had, into the stock market, the S&P 500, your money would be worth $1,375,000. Hot diggity, that's pretty good. Not bad at all. Let's look at gold. Let's say you bought gold, $250,000 of the gold in 2011. The average price, it went up and down, was about $1,400 an ounce roughly. And right now it's around $2,400 an ounce. So your gold would be worth $428,571. That doesn't include selling it because there's a cost to sell it, okay? Silver, on the other hand, was at an absolute high in 2011. It went as high as $48 an ounce in 2011, but you could say an average of about $30 an ounce. Right now, it's about $29 an ounce today. So you would have $241,667 in silver. Now, does that mean silver is a horrible investment? There's a lot of timing involved with this. Had you bought it when it was very low at $15 an ounce, you'd have doubled your money. Same thing with gold. It went down since 2011, then back up again. And stocks, same thing. 2011 was an absolute low for the stock market. It was also an absolute low for real estate. So we're going to look at what happened if you would have invested $250,000 and you bought real estate with that money, and where you would be today, July 2024. What would you have in your bank account if you sold everything? Now, let's talk about real estate. The one thing in real estate that you can do, which is extremely advantageous, is you can do what's called leveraging. Leveraging means you don't just take your $250,000 cash and use it to buy one property. What you do is you get a loan and you use that $250,000 to put it down to get more property. With that $250,000, you could have purchased in 2011 6 properties costing you $1 million. I looked it up. This is in my market, so each market's different. You could buy 4 houses at $150,000 and 2 houses at $200,000. The homes for $150,000, believe it or not, were about 1,490 square feet, 3-bedroom, 2-bath, 2-car garages, built in 2006. And the two $200,000 properties would be 2,300 square foot, 4-bedroom, 3-bath homes with a 3-car garage for just $200,000. Now, let's say you bought all those houses and you got a mortgage at 3.5%, because that was the going rate in 2011. Now, rates are higher now. Things are a little bit different, but we're just going to look at what would have happened. And remember, in 2011, real estate was at a low and the stock market was at a low. So it's very comparable, okay? So you buy your 6 properties. I figured out what your rent would be and what your mortgage payment would be. Your gross annual rents, that means what you take in gross rents, not expenses yet, we'll get there, would be $87,600 worth of gross rents. Your mortgage payments with principal, interest, and taxes, estimation, because each house is a little different, some perfect, was about $56,500. Now we're going to fast forward 12 and a half years to today. What does it look like? So in July of 2024, your gross rents over that 12 and a half years would be $1,481,050. Your total expenses for your mortgage payment and taxes and insurance would be $760,000. Now, that's your gross amount you paid. Part of that went to principal. How much went to principal over that time? $244,000 you paid down in your principal over that 12 and a half year period of time. So we're going to be a little more realistic on this, because let's look at real numbers. A good rule of thumb for an investment property is 25% expenses. Like, let's say you had a professional property manager at 10% and you had 15% expenses per year. Also, you have some vacancy put in there where people might not be in the home 24/7. So we'll just call it 25% expenses, and that's pretty reasonable. So the net amount you would have gained in cash, which means your gross rents minus your mortgage payment, taxes, and insurance, would be $595,000. That's what you would have made in cash return. Now we're going to sell these properties today. As of today, those properties that you spent $1 million on are now worth $3 million. Okay. So that's a good return on investment, especially because you're only into this $250,000. And you put $595,000 in your pocket cash. So you got all your investment back. Now, I'm not going to include commissions and all that. You can do that later. Let's just say 6%, but we're not going to have that in my numbers, okay? So we sell the properties for $3 million. The payoff is $506,000 for a total net gain of $2,494,000 plus $595,000 cash you put in your pocket. So your total return on investment from $250,000 in 2024, if you invested in 2011, is $3,089,050 for a grand total of 1,235% return on investment gain. The S&P had a return on investment of, what was that? Maybe 300%? So you're basically outperforming. You had $1,375,000 in the S&P versus $3,089,050. Now, the other thing you got to consider with real estate that to me makes a big difference, the stock market is nothing but air. It's just paper. I mean, tomorrow, if something really bad happened, the stock market could go back to 15,000 levels, and then where'd all your money go? You got nothing to show for it. Whereas if you bought those houses in 2011, you still have something to show for it. No matter what, you have a place to stay. You have a place to put family members. You have a place to put friends. You have a place to rent to somebody. Even if the rents go down, you still got something. Yes, real estate can go up and real estate can go down. That is true. Anything can go up and down. However, it's real. It's tangible. It's something you can hold in your hand. People are on the radio are saying, gold, gold, silver, silver. I'd rather have a house, wouldn't you? You can't live in your gold. You can't live in your silver. You can't have, the gold doesn't keep the rain off your head, but a house does, and it helps people. So there you go. See how real estate beats the socks off of everything else? But wait, there's more. We got bonus features. Here's the bonus features for real estate that you don't get in stocks, you don't get in gold, you don't get in silver, and that's called depreciation. So when you depreciate a property, this is getting in the weeds a little bit, talk to your tax accountant, it reduces your total tax liability and reduces your taxes. So it's a great benefit. Also, gold, silver, and stocks don't keep out the rain. Houses do. You can't put your relatives in stocks, bonds, gold, and silver. You can in your rentals. You're helping the community because you're putting people in places where they can stay. Real estate is the only way to go, and real estate in Arizona is the best place to go. So if you're looking to spend some cash, give me a call, 928-636-7000, or email me at peter@listingprescott.com, or like me on Facebook. Follow me on X. and subscribe to my YouTube channel because you're going to get the best information on Moveonomics every time. We'll see you next time.